Hi, thanks for taking the time to view this video sharing our current thoughts on the financial markets. I'd like to start by reviewing a summary of our conclusions from our July video. This is still available on our website for your viewing. At that time, we were optimistic about returns from global stock markets over the next 5 years. Volatility in stock prices had been low over the last 3 years, but could increase in the near future due to geopolitical concerns and increasing United States interest rates. Expect a 10% to 15% temporary decline in equity prices at any time. Expect lower returns over the next 5 years than those over the last 5 years. Profit from volatility by keeping sufficient amounts of cash in short to intermediate term bonds to ensure that you don't have to sell stocks when prices go down. We still hold these views. Although stock prices have become more volatile recently, as we predicted, we are still optimistic about returns from global stock markets over the next 5 years. This chart of world stock market performance shows the volatility we experienced in the third quarter. Generally, globally diversified stock portfolios were down about 2.2% for the quarter, given the ups and downs. The divergence in various stock asset classes was significant, though, as the S&P 500 index produced a return of positive 1.1%, but United States small value stocks produced a return of negative 8.6%. Most foreign stock market indexes also produced negative returns during the quarter. Economic news was generally positive, but geopolitical news was generally negative. The Middle East is a scary place, but global stock markets will likely be resilient in spite of that. Our chart of asset class returns shows the returns from the third quarter and the wide divergence in asset classes. As you view this chart, however, you will note the changing leadership from year to year. It is best to view returns over as long a time period as possible. For the asset classes reflected, the 10-year returns are best for emerging markets at an average annual return of 11.5%. United States small company stocks were next best with an average annual return of 9.1%. Foreign developed market stocks produced an average annual return of 7.4%, as did the United States S&P 500 index. Over the last 10 years, investors with globally diversified stock portfolios benefited from emerging markets and United States small company stocks. Since March 9, 2009, the S&P 500 index is up by 192%. However, current price-earnings multiples are at average levels. During most prior stock market cycles, stock prices did not stop at average levels, but instead went to valuations higher than average. For example, in the 1990s bull market, stock prices advanced 180% to get to average valuation, then increased another 83% before peaking. The fear of the Federal Reserve increasing interest rates is suspected to have produced some of the recent volatility in stock prices. When interest rates are as low as they are now, rising interest rates have coincided with rising stock prices. Interest rates would have to increase almost 3% from current levels to adversely impact stock prices. There are 4 things that are positive and likely to drive growth in stock prices higher. Unemployment in September is reported at 5.9%. This is now less than the 50-year average of 6.1%. Since the recession ended in 2009, 10 million net new jobs have been created by employers. The declining unemployment rate is already causing a tightening of the labor market. Average hourly earnings growth is now about 2.5% over last year and likely to continue to trend higher. Consumer confidence is improving. The University of Michigan index is at 84.6, up substantially from the depths of 2009 and at about average levels over the last 40-plus years. Further increases in consumer confidence could produce increasing stock market valuations, as there is some correlation between the two. The United States is producing much more energy due to extensive shale deposit drilling. As a result of this, we are importing much less oil and are much more self-sufficient. The huge reduction in imports has favorably affected our balance of trade with the rest of the world. The value of the dollar is increasing against other major currencies. When the value of the dollar increases, it makes imports to United States consumers cheaper. This should be favorable to companies in Europe, Japan, and other countries that export to the United States. Recent reports have indicated that growth in many foreign countries is slowing, and there are fears that some world economies could sink into recession. More exports to the United States will offset some of this weakness. In spite of the recent concerns expressed about global economic growth prospects, actual growth has been buoyant, better than 4% in emerging economies and about 2% in developed economies. These levels are judged to be sufficient to allow continued corporate earnings growth. United States stocks are trading at price-earnings multiples slightly above average. With continued increases in corporate earnings, United States stock prices should continue to trend higher, especially if price-earnings multiples continue to increase due to continued improvement in consumer confidence. Price-earnings multiples are lower in most developed foreign countries. Given where the United States is relative to other major economies, it is likely that corporate earnings growth will be better in foreign countries than the United States in the near future. So, better earnings growth with more upside potential to price-earnings multiples make foreign stock markets attractive today. Price-earnings multiples are lowest in emerging countries today, and corporate earnings have more significant upside potential. Emerging markets are also judged by us to be very attractive today. Okay, to summarize then, we expect global economic growth to continue and perhaps accelerate. Stock valuation multiples are reasonable in the United States and appear to have upside potential. Stock valuations are more attractive in developed foreign economies and most attractive in emerging markets. Greater stock market volatility is likely to continue as investors anticipate the Federal Reserve increasing interest rates and as concerns about global economic growth and its sustainability continue. Investors should be rewarded for taking volatility risk with positive global stock market returns over time. We believe the best course of action for investors is to maintain their long-term view of the financial markets and not make changes based on short-term developments. We believe the best protection for investors continues to be a broad and globally diversified investment strategy. One should keep sufficient amounts in cash and short and intermediate-term bonds to meet spending and other needs so that stocks don't have to be sold during periods of temporary decline. Thank you for taking the time to watch this video. As always, please feel free to contact me or your lead advisor if you have questions.